Chapter 10. Process and Operation Costing. Learning Objectives. State the meaning of process and operation costing. Compute equivalent completed production units. Discuss the various methods of valuation of work in process. State the meaning and treatment of inter-process profits. Process costing. Meaning. Process costing is a method of costing used in industries where the material has to pass through two or more processes for being converted into a final product. It is defined as a method of cost accounting whereby costs are charged to processes or operations and averaged over units produced. Features. Each plant or factory is divided into a number of processes, cost centers or departments, and each such division is a stage of production or a process. Manufacturing activity is carried on continuously by means of one or more process run sequentially, selectively, or simultaneously. The output of one process becomes the input of another process. The end product usually is of like units not distinguishable from one another. It is not possible to trace the identity of any particular lot of output to any lot of input materials. For example, in the sugar industry, it is impossible to trace any lot of sugar bags to a particular lot of sugar cane fed or vice versa. Production of a product may give rise to joint and/or byproducts. Costing procedure in process costing. Materials. Notes from the stores. Each process for which the materials are used, are debited with the cost of materials consumed on the basis of the information received from the cost accounting department. Employee cost, labor. Each process account should be debited with the labor cost or wages paid to labor for carrying out the processing activities. Direct expenses. Each process account should be debited with direct expenses like depreciation, repairs, maintenance, insurance etc. associated with it. Production overheads. Expenses like rent, power expenses, lighting bills, gas and water bills etc. are known as production overheads. Usually, these expenses are estimated in advance and the processes debited with these expenses on a predetermined basis. Treatment of normal, abnormal loss and abnormal gain. Normal process loss. It is also known as normal wastage. It is defined as the loss of material which is inherent in the nature of work. Treatment in cost accounts. The cost of normal process loss in practice is absorbed by good units produced under the process. The amount realized by the sale of normal process loss units should be credited to the process account. Abnormal process loss. It is also known as abnormal wastage. It is defined as the loss in excess of the pre-determined loss, normal process loss. Treatment in cost accounts. The cost of an abnormal process loss unit is equal to the cost of a good unit. The total cost of abnormal process loss is debited to costing profit and loss account. Abnormal process gain/yield. The difference between actual and expected loss or actual and expected production is known as abnormal gain or yield. Treatment in cost accounts. The process account under which abnormal gain arises is debited with the abnormal gain and credited to abnormal gain account which will be closed by transferring to the costing profit and loss account. Valuation of work in process. Work in process can be valued on actual basis, that is, materials used on the unfinished units and the actual amount of labor expenses involved. However, the degree of accuracy in such a case cannot be satisfactory. An alternative method is based on converting partly finished units into equivalent finished units. Equivalent completed unit is equal to actual number of units multiplied by percentage of the completed process or work. Steps in process costing. Step 1. Analyze the physical flow of production units. Step 2. Calculate equivalent units for each cost elements. Step 3. Determine total cost for each cost element. Step 4. Compute cost per equivalent unit for each cost element. Step 5. Assign total costs to units completed and ending WIP. Process costing methods. First in first out, FIFO, method. Under this method the units completed and transferred include completed units of opening work in process and subsequently introduced units. Weighted average, method. Under this method, the cost of opening work in process and cost of the current period are aggregated and the aggregate cost is divided by output in terms of completed units. Inter-process profits. In some process industries the output of one process is transferred to the next process not at cost but at market value or cost plus a percentage of profit. The difference between cost and the transfer price is known as inter-process profits. Advantages. 1. Comparison between the cost of output and its market price at the stage of completion is facilitated. 2. Each process is made to stand by itself as to the profitability. Disadvantages. 1. The use of inter-process profits involves complication. 2. The system shows profits which are not realized because of stock not sold out. Operation costing. This product costing system is used when an entity produces more than one variant of final product using different materials but with similar conversion activities. Which means conversion activities are similar for all the product variants but materials differ significantly. Operating costing, also known as hybrid product costing. Thank you.